$80 million does not disappear by accident. It moves through signatures, wires, invoices, company records, property transfers, and people who believe nobody will ever look closely enough. In this case, the divorce was supposed to be simple on paper. A wealthy founder, a long marriage, a lifestyle built around private jets, coastal property, investment, and a business empire that looked successful from the outside. But when the marriage collapsed, the numbers suddenly changed. The husband claimed the fortune was not what it seemed. He said the company was under pressure. He said several investments had lost value. He said cash flow was tight. He said the market had turned against him. And most importantly, he said there was no hidden, but one document would later change the entire case. The names in this story are changed, but the pattern is real. This is the kind of case forensic accountants see when wealth, divorce, control, and deception collide. At first, the wife's attorneys had a basic question. Where did the money go? For years, the couple had lived like the money was endless. There were homes in more than one state. There were luxury vehicles. There were art purchases, private club memberships, rare watches, and large transfers that moved through accounts most spouses never see. Then, during the divorce, the financial picture became strangely modest. On paper, the husband claimed his net worth had dropped dramatically. His attorneys presented financial statements showing heavy business debt, declining revenue, and several investments that were supposedly locked up or worthless. The problem was not that businesses lose value. That happens. The problem was timing. The collapse seemed to begin right when the divorce became unavoidable, and that detail mattered. The wife, who had not managed the family finances directly, could not explain every account, but she knew the homes. She knew the spending. She knew what had been normal just months before. So her legal team brought in forensic accountants, not bookkeepers, not regular tax preparers, forensic accountants. Their job was not to accept the story. Their job was to test it. They began with the obvious records: tax returns, bank statements, corporate filings, loan applications, brokerage accounts, property records, and business ledgers. And at first, the husband's version looked organized, almost too organized. The records showed a company with shrinking profits. They showed consulting expenses. They showed loans to related entities. They showed large payments to vendors. They showed cash moving out of the main operating business into other companies that appeared to have legitimate purposes. On paper, it looked like normal business complexity. In reality, complexity was the shield. The husband had built his wealth through a private logistics and technology company. It was not publicly traded, which made the valuation harder. There was no daily stock price. No public market number. No simple answer. That gave him room. According to the financial records reviewed in the case, he claimed the business was worth far less than his wife. He pointed to debt, delayed contracts, and projected losses. He argued that future income was uncertain. But forensic accountants noticed something strange. The business was supposedly struggling. Yet money kept leaving the company in clean, repeated patterns. Not chaotic spending. Not emergency payments. Patterns. Several vendors were receiving large payments for vague services. The descriptions were generic: advisory work, licensing support, international consulting, market development. Now, vague invoices are not proof of fraud, but they are a place to start. The investigators compared the invoices to emails, contracts, tax forms, and bank records. And this is where it gets interesting. Some vendors had almost no digital footprint, no real website, No employees listed, no physical office that matched the scale of the payments. Some business addresses led to mailboxes, shared office spaces, or residential properties. The money was not disappearing. It was being redirected. One company, called in the case file a strategic consulting partner, had received more than $9 million over 18 months. Another had received $6 million. A third had received nearly $4 million through a series of smaller transfers that looked routine when viewed, but when the accountants mapped the transfers on a timeline, the pattern became obvious. The payments increased after the divorce discussions began. Then they accelerated after the first legal filing. And then came the mistake. One of the consulting entities had submitted an invoice using the wrong internal reference number. It was a small clerical error, the kind most people would ignore, but forensic accountants do not ignore small errors when millions are moving. That reference number matched a project code used inside the husband's main company. It linked the outside vendor to an internal business unit controlled by one of his closest executives. From there, investigators began pulling threads. Emails showed that the vendor was not operating in several messages. Company employees discussed the vendor as if it were part of the same operation. Draft invoices were edited by staff inside the husband's company. Payment timing was discussed internally before the invoices were officially submitted. But the biggest mistake was still hidden inside a bank subpoena showed that one consulting company had wired money to an offshore account shortly after receiving payments from the husband's business. Then another related company did the same. And then another. The offshore account was not in the husband's personal name. That would have been too obvious. It was tied to a trust structure. On paper, the trust looked separate. It had trustees. It had layered entities. It had legal language designed to create distance. But the forensic team followed control, not just ownership. That is the difference between a normal financial review and a forensic investigation. A person can say they do not own something, but if they control it, benefit from it, direct it, or use it, that story can collapse fast. Investigators looked at who authorized payments, who had communication with trustees, who received reports, who gave instructions, who used trust-owned assets, who had access to the accounts. And what they found changed everything. The husband had allegedly claimed he had no control over the trust, but emails suggested he was receiving regular updates about its holdings. Calendar entries showed meetings with advisors connected to the structure. Travel records placed him near properties linked to entities funded by the trust. Then property records revealed a coastal home believed to be owned by an unrelated company had been purchased shortly after a large transfer moved through one of the consulting vendors. The money moved from the main business to a vendor, from the vendor to an offshore account, from the offshore account into an entity, and from that entity into real estate, not in one dramatic transfer. In pieces. That was the point. The real problem was not the money he moved. It was the trail he left behind. Forensic accountants built what is called a source and use analysis. In simple terms, they compared where money came from with where it ended up. They did not need a confession. They needed alignment. Dates, amounts, entities, transfers, documents, property purchases. Invoices, emails, tax positions, lifestyle spending. When enough points lined up, the explanation became harder to believe. The husband's team argued that the transfers were legitimate business expenses. They said offshore structures were common in international business. They said the trust was separate. They said the real estate was not marital property. But here's the thing. Financial truth does not depend on what something is called. A fake consulting fee is still a transfer of value. A shell company is still a shell company if it has no real business purpose. A trust is not automatically untouchable if one spouse secretly controls the assets. And a property is not separate just because the ownership is buried under layers of entities. The accountants then reviewed lifestyle spending after the alleged collapse. If the husband was truly under financial pressure, his personal behavior did not match the story. There were private flights, high-end purchases, large payments to personal staff, insurance premiums on valuable assets, maintenance costs for properties he said he did not control. One payment stood out. A luxury yacht management bill had been paid by an entity that was supposedly unrelated to him. That bill included a contact email, his assistant's email. That detail mattered. The yacht had never been listed as a marital asset. It had never appeared in his original disclosures. It had been placed behind an ownership company connected to the same network of entities receiving money through the consulting payments. By the time investigators saw the pattern, the story was no longer about suspicion. It was about proof. The wife's legal team presented the findings in court filings. They argued that the husband had dramatically understated marital wealth. They claimed that assets had been moved, disguised, or placed under structures designed to make them look unavailable. The court did not have to rely on emotion. It had documents. Bank records showed money moving out. Invoices showed the cover story. Emails showed control. Property records showed where some of the money landed. Trust communications showed access and influence, and lifestyle records showed the benefit. The alleged $80 million lie was not one hidden account. It was a system. That is what made the case so powerful. Hidden asset cases are rarely built around one smoking gun. They are built around contradictions. A spouse says there is no cash, but millions are wired to unknown vendors. A company claims hardship, but insiders keep funding luxury assets. A trust claims independence, but the same person gives instructions behind the scenes. An asset is missing from disclosures, but bills connected to that asset are paid by the same financial network. One contradiction can be explained. 10 contradictions become a map. And in this case, the map pointed back to the money. The consequences were severe. The husband faced court sanctions. His credibility was damaged. The financial disclosures were reopened. The business valuation had to be re-examined. The supposedly separate entities became part of the legal assets that were once hidden behind legal structures were brought into the discussion. And perhaps most damaging, the court began viewing every future explanation through a different lens. Once a judge believes someone has hidden money, the entire case changes. Every number becomes suspect. Every missing document matters. Every delay looks strategic. Every vague answer creates risk. The divorce was no longer only about dividing wealth. It became about whether one party had tried to manipulate the system itself. Now look, forensic accounting is not magic. It is slower than people think. It is document heavy. It is expensive. It is tedious. It means reading thousands of pages that look boring until one line changes the whole picture. But that is exactly why it works. Fraud usually depends on people getting tired tired of asking, tired of reading, tired of tracing, tired of fighting through complexity. Forensic investigators do the opposite. They slow the story down. They follow the money one movement at a time. They look at the bank account behind the invoice, the company behind the bank account, the person behind the company, the asset behind the person, the benefit behind the asset. And eventually the lie has to carry too much weight. In this case, the alleged deception failed because the financial story did not match the human story. A man claimed he had lost access to wealth while records suggested he still controlled it. He claimed vendors were independent, while emails suggested coordination. He claimed assets were separate, while payments showed personal benefit. He claimed the money was gone, while the trail showed where it had gone. That is the part people misunderstand about hidden assets. Money can be moved. It can be renamed. It can be routed through entities. It can be placed offshore. It can be wrapped inside trucks. It can be converted into property, collectibles, business interests, or crypto. But every movement creates a record somewhere. A bank log, a wire instruction, a title document, a tax form, a device backup, a calendar entry, an email, a mistake in an invoice. The person hiding the money only needs to be perfect once. Investigators only need one opening. And here the opening was small, a wrong reference number, a strange invoice, a vendor that did not look real, a trust that was not as independent as it claimed, a luxury bill tied to the wrong email. Small details, big consequences. The final settlement was not just about numbers, it was about leverage. Once the hidden structure was exposed, the balance of power shifted. The spouse who had been told there was nothing left could now point to records showing a very different reality. The lie had been expensive. But the exposure was more expensive. Because in divorce, hidden assets do not only create financial risk, they destroy credibility. And credibility is one of the most valuable assets in any courtroom. When the case began, the question was simple. Was the fortune really gone? By the end, the answer was much darker. The fortune had not vanished. It had been dressed up, moved around, renamed, and buried under paperwork. But paperwork cuts both ways. It can hide the truth for a while. Then it can reveal everything. And if you want more real cases of hidden money, offshore fraud, and forensic justice, subscribe to Hidden Assets Exposed, because every hidden dollar leaves a trail.